Welcome back, you legends. I'm Dr. Cal, and let's jump right into today's video. Again, red all over the place on the stock market map today, with a few exceptions. Today was a more typical risk of trade in the market, with utilities, defensives, and healthcare leading. Target did report before the market opened, and they surprised to the upside big time on their EPS. Earnings were up 25%, or I should say, surprised by 25%. Revenues were slightly below expectations, 1.6% miss. But that was obviously more than made up for with that big earnings surprise. Tesla, Amazon down big, Meta down big, Bank of America down big, AMD, Intel, chip makers basically down big today. Let's take a look at the different indices. All red today, with the Russell down 1.2%, S&P 500 0.7%, the NASDAQ 1.15%, and the Dow Jones half a percentage point in the red. Let's take a look at the different sectors. More typical risk off day today versus what we had yesterday. We had utilities and defensives leading, with cyclicals and communication services as well as tech lagging the market. Let's take a closer look at the daily chart for the S&P 500. This bright blue line was a key support line that broke today at the end of the trading session after the FOMC minutes came out. To me, the FOMC minutes did not surprise. A lot of the FOMC members talked about the potential need for an additional rate hike to combat the resurgence in inflation. That's not really a surprise because Neil Kashkari came out yesterday and he basically said the same. So he was signaling towards what was coming in the minutes. Not a surprise to me personally, but the market did not like it. Initially, the market was fine. Initially, the market actually rallied on the release. Here it is, a small rally. Then it broke below this key support line. This is the 10-minute chart, guys. Broke below the key support line. On the futures, it's a more obvious structure here. Very clear descending channel. Bounced off it multiple times, ping-ponging between the support and resistance of the descending channel. Usually at the end of a down a down move, of a correction, whatever, a sell-off. Usually at the end you get these waterfall style sell-offs. It's quite often how they actually end. They just break the channel. What actually it ends up happening most of the time is you double the distance of the channel and you get the bottom. Okay, that's usually how it works. When the channel is broken, you double the distance, and a tag of this lower band would give you the final low. Okay, so what does that actually look like? Let's take a look. We double the channel. We take our measuring tape from the close of today down to the lower edge of the channel support, about 1% down. We take a look at the S&P 500. What does that look like on the SPY ETF? Let's measure 1% down from the close of today. That's about 435. What's at 435? Is there anything interesting at 435? Well, we have this cluster of buys. Then we have this really important gap at 430. I think it's early to see a gap fill at 430. It might happen, but I think it's a little bit early. Usually you see something more in line of this, right? A lot of choppiness. Then you get the gap fill at 430. But there's an important gap there. And if I take a look at the volume profile, let's go from the volatility contraction pattern back in May. Let's measure to today. Here it is. This is the volume profile. Where do we have volume nodes? We have one node here. We have another one obviously here. These volume nodes represent the most traded areas in the market, most traded prices. These empty spaces here, they represent pockets. Usually, guys, in pockets, price action moves very quickly, right? So if we end up, for example, breaking below 430 at some point in September and October, usually that would mean a huge down move, very quick down move, and then potential very quick recovery, because these gaps really act as air pockets, right? Price moves very quickly between these air pockets. And that's what happened at the volatility contraction rally. We saw a price move very quickly. Look at this. A couple of days pretty much filled this air pocket. Okay, so based on the channel distance on the futures, we're expecting 1% potentially before this low is made. And again, we have this volume node here. It ends, let's take a look, 434.5. Again, so that makes sense. So we have a volume node and channel support potentially coming in here. If we take a look at the NASDAQ, something else interesting is also happening. This is the 2-hour chart on the NASDAQ. We do have this major trend line support. It acted as support back here at the major low in March. It also acted support at the major low in January. And it should act as support at least initially. At least initially, this trend line should hold and we should see bounces off it initially. That's very important. These major trend lines, usually you get a reaction off of them. And if we take a look here, let's measure from the close of today down to the trend line. We're looking at just under 1%, just under 1% to this exact same node that we saw on the S&P 500, this cluster of trades, a lot of liquidity here. So I expect a slow turn in the price action here. This entire area, guys, if you notice, this is a big block of volume, right? Not a lot of air pockets here. That's why price was very choppy. It's taking its time. Up, down, up, down, up, down. That's what happens when there's a lot of volume traded. And we're still in that. We're actually entering an even higher volume area. So expect even more chop in the coming days. Now, an important thing happened yesterday that I mentioned. That was the close below the 50-day moving average. Usually one close is fine, but if you get follow through the second day, that confirms the close below the 50. And what often happens when we hit the 50-day moving average and close below it for a couple of days or more, that usually signals that there's more downside pressure. Not necessarily immediately, but it's a clear signal that this sell-off is a big sell-off. It's not just a pullback. Sentiment is very bad. Usually if sentiment is okay, you would get support at the 50-day. We cut right through it yesterday. We rejected it again today. We tried to rally towards the 50-day. We actually cleared it just about intraday. Then we completely rejected and formed this hammer candle, inverted hammer candle. Somewhat of a hammer candle. It has a larger body than a hammer, but you have the tail, or I should say the wick to the upside and the body to the downside, all red candle. It's a bearish candle, bearish follow-through candle, just like the one from yesterday. Now, interestingly, volume was slightly up from yesterday. We're not seeing really big selling volume. Not yet, really no big selling volume, just above the average of the volume traded today. The PPO is still pointing down. Histogram actually printed another big red bar today, and we're about to cross the zero line. Usually when we cross the zero line, we get even more selling. So if there's no buying at all at the zero line or just above it, that would mean that we potentially could see even more selling. We could potentially see it selling throughout August if that continues to happen. But even in that case, rebounds or relief rallies are likely that they are actually necessary. So even if we see something as severe as this, you'd see something like that and more downside. So if we see some really, really bad waterfall size selling, you'd see some really strong rebound after that. And that usually is a false rebound. Okay, so I showed you on the NASDAQ chart, the triple Qs, we had this support line that should hold. We also have a similar support line here on the S&P 500. It's quite a distance away, price is quite a distance away from this support line. So it might take a while still to tag it, potentially somewhere in September or thereabouts. So what's happening with key indicators like the VIX? Let's take a look at the VIX again. Again, the VIX printed another bullish divergence today, made a lower high as the S&P 500, made a significantly lower low. This is a huge divergence, much lower low on the S&P, much lower high on the VIX. We could still see another spike in the VIX tomorrow, but very likely will not clear the 18 reading. We might get another VIX spike at the open, okay, and we would still establish a bullish divergence even if we get another sell-off tomorrow and another spike in the VIX. Very likely still another bullish divergence on the VIX. I showed you guys a lot of these divergences in yesterday's video. Here are a bunch of them. Right, we have lower low on the S&P, lower high on the VIX. The VIX did not corroborate the lower low. The market ended up rallying. Here's another one, very clear. Equal highs on the VIX, lower low on the S&P. The VIX did not corroborate the lower low. The market rallied. Another one is right here, significantly lower low on the S&P 500 and a lower high in the VIX. The VIX did not corroborate the lower low. The market rallied. So in either case, we're still seeing that bullish divergence on the VIX. Whether that breaks out next week, tomorrow, we simply do not know. Maybe it happens Friday. No idea, but it is there and it's very pronounced. Now we have to talk about maximum pain. Maximum pain this week opened at 438. It went up to 440 yesterday. It's back at 439 today. This is the maximum pain level. The maximum pain level is the price at which option sellers make the most amount of money. Okay, most options expire worthless if we hit the maximum pain reading. This week is OPEX, option expiration, so we would normally expect the maximum pain level to be hit in OPEX weeks. We basically hit that level today. We still have 2 days of trading, tomorrow and Friday. So very likely if we get a sell-off tomorrow, we'll get a rebound Friday. Or if we get a rebound tomorrow, we'll get a sell-off Friday. Either case, very likely we'll close at 439 or thereabouts to end the week. That means price should not change from today till the close of Friday, not change much at least. But between today and Friday, I expect a lot of chop. So again, if we get a sell-off tomorrow, big rebound Friday likely. If we get a rebound tomorrow, big sell-off Friday likely, just based off the dynamics of maximum pain. Now let's take a look at the S&P 500 1-hour chart. This is the 1-hour chart. I do want to point out a few key changes on the chart. Number one, we hit this key target. We closed exactly at support at 439 and 0.6 and change, 439 and change. We did break below this short-term support, the same trend line that I showed you on the futures. Here it is. We broke below it today. We are establishing bullish divergences, but so far the market has been ignoring most of these bullish divergences, so I'm not sure how much weight we're going to put behind them, but they are there. Additionally, we have the stochastic in extreme oversold territory. Anything below 12 is extremely oversold. We are now below 10, so extremely oversold. In fact, if we go back in time, we'll see that every single time we hit a reading below 12, the market actually had a small bottom and rebounded. Here it is below 12. And market had a small bottom and rebounded. Let's take a look. Here's another one. Market bottomed, rebounded. Let's take a look. Another one is right here. The market actually was forming the low and rebounded and rallied. Another one is this. Market already bottomed. Another one is this. The market was bottoming and it rebounded. Let's take another look. Here it is, going back to April 5th. And again, bottom, rebounded. Let's go back even further. Let's go back to when things were really crazy. Let's take a look here. March 8th, again, we had a small rebound, small bottom. It happened again. Let's see, March 10th, and it corroborated another bottom. We rebounded. Let's go back even further. Let's go back to the end of February. And here we'll find the first example when we were in extreme oversold and we still had some more downside, and then we rebounded, okay? And the rebound was very anemic from the bottom. Let's take a look. It was just 1%, so $4. That was it. If I actually look very carefully at the shape of the stochastic, it's looking very similar to today's print. It's looking very similar. Let's take a look. The green is pointing down. It is flattening with the red moving closer. It is flattening right? It's not a sharp sell-off and a move back up. It's not as sharp as any of these. It's a slow grind with the green moving closer to the red. So let's take a quick look at what happened today. And again, similar look, right? Slow grind of the green, moving average, moving closer to the red. So potentially, again, potentially more selling to open the day tomorrow and then a rebound, or we gap up and then we sell and then we rebound, something like that. But in any case, when we get down to these levels, it makes no sense to short the market. When it's this oversold, it really makes no sense to short the market when it's this oversold. Might as well just wait for momentum to start building back up and then short again, at least back at the 50 level. We take a look at the sell-off. Again, I want to point out a few key things here. Every time we went back to the 50 level, we had a top. Here it is, top at the 50. Again, let's take a look. We didn't get even to the 50 here. 59, it marked a top. By the way, this was supposed to be a rebound trade with more upside, but it was cut short in the post market, or I should say in the pre-market of the next day, when all of that bad news out of China came out and this rally was cut short. But it was supposed to be another day of rebound and then more selling. This was cut very short. This was pretty sneaky because this was a clear bull flag and it broke out and it closed above the 5-day. Okay, let's take a look at the smart money. Smart money up top, S&P 500 down below. Just like the VIX, we're getting a bullish divergence. It hasn't yet played out. It hasn't played out. It's taking quite a while, but sometimes it takes a while. Here's another one. It took quite a few trading days before this bullish divergence played out. We could see another down day in high yield bonds, and the bullish divergence would still be there. So it's there today, and it will probably still be there tomorrow. Let's take a look at XLY divided by XLP. This is consumer staples divided by consumer discretionary. This is consumer discretionary divided by staples. And we were forming this bull pennant. Today, we actually broke below it. So this bull pennant might actually continue to break to the downside. We had a red print on the histogram today, volume slightly higher. So it looks like this bull pennant will fail and we'll get more selling in discretionaries, things like Tesla and Amazon. In fact, let me pull up Tesla because I want to show you what's happening on Tesla. Here's Tesla. We were watching this gap at 235 to get filled and act as support. It acted as support for a couple of days, and that was it. And then it was cut through very quickly. So no support at all for Tesla, all the way down to roughly 200, where we have a cluster of trades here, some trades here, some volume here, and that's it. This entire area is a pocket, and in pockets, again, price moves very quickly. So no real buyers here unless and until we go back probably to the 200-day, just around the $200 level on Tesla, potentially slightly lower to fill this gap to at 193.4. This will probably take a while, guys. So if you're shorting Tesla or doing something like that, just be mindful that it'll probably take some time. It won't just look like this. We'll probably get a lot of chop, okay, and it'll probably take some time. The ideal entry for a setup like this, especially with a spike and cup top. This is a spike and cup. This is the spike, and this is the cupping formation. The ideal entry is after the break, we wait for the back test, we enter on the back test, and then we ride the entire move to the downside. So we have to wait for the back test of this gap. That would be the ideal, the objective entry to try and sell something like Tesla. Okay, let's talk about the Dow Jones. Big sell-off yesterday, another big sell-off today. The Dow Jones was flagging, was forming a bull flag. That bull flag has failed yesterday when we had that gap down and sell-off. In terms of support on the Dow, clear, obvious level of support is this. Let me highlight it with a box. Here it is. This is the level of support, 50-day moving average. Trades, several resistance trades here, rejected. Let's see, once, twice, 3 times, then broke through. This is now a pivot. a pivot zone, a prior resistance now should be support. Several trades here, so likely support around 340, 345 to 340, somewhere around there. Now, if we see something similar to the S&P, we had a pivot zone here. It was cut through. It was broken. Likely we'll see the same with the Dow Jones. It will probably cut through it and break it. And we're looking at this gap to be filled at 342. So likely slightly undercutting this pivot zone to 342 to find support. Let's take a look at the Qs relative to the S&P 500. I talked about this chart. It's a key chart that really underlines the relative performance of tech in general to the S&P 500. It was in this very clean bullish channel. It broke. And usually, again, guys, when something like this breaks, we double the distance and we get support. So still a lot of downside left for tech. And if I actually look at some of the key tech names here like Microsoft, massive double top formation on Microsoft. We are now below the zero line on the PPO, and we printed a tombstone candle today. Very bearish looking chart, no support at all, no support at all for Microsoft until at 290. So still a lot of downside for Microsoft, 8.5% likely, taking place over a couple of months, so August, September, and potentially into mid-October. And again, very unlikely we'll see a straight line trade like this. We'll probably see something that looks like this, right? A stair step down and a bottom sometime in mid to late October, okay? That's very likely what we'll see, with a lot of tags at the 20-day and the 50-day and all of these moving averages getting tagged at least several times in a sell-off this large. Let's take a look at Apple. Apple, again, major top on the daily chart. Huge negative divergences on the daily chart. It was rallying to the upside and printing multiple negative divergences. I can count at least 1, 2, 3 negative divergences just in the past 3 months. This is a very difficult chart to read because honestly, there's no support, no obvious level of support other than 176 where we are right now. No other obvious level of support, and 176 doesn't look like a solid level of support. There's no moving averages here. Some traded volume in the past, but not a lot. So I had to draw in a combination of the volume profile and the VWAP, the volume weighted average from the January bottom, and combine that with the Fibonacci levels. And we have some convergence here. We have the 50% Fibonacci level, we have this volume node, and we have the volume weighted average, all pointing toward, let's see here, between 165 and 162. So still at least 10 additional dollars to the downside on Apple. Again, not likely it happens in a straight line. And I actually expect some huge moves from Apple, something that looks more like this. A huge move to the upside, tag the 50-day before going lower. So huge tag at the 50-day potentially by the end of the month or early September. Then continuation to the downside. Again, that would be the ideal short entry, not here. It's not the ideal short entry, not the objective short entry. The objective short entry would be break of the 50, a back test, and then you would enter at the back test and rejection and write it down. That would be, let's take a look here, let's measure it. That would be a 13% downside move from the back test. So a lot of downside still left in Apple. Okay, let's take a look at the S&P 500 breadth. Breadth is now at the 200-day moving average, and it acted as support prior in the year. We're not sure if it will act as support again. So that's interesting. If we take a look at the 50-day breadth, 50-day breadth is collapsing. It is starting to look very bad. This is the 50-day breadth. It was forming this bearish ascending wedge. As soon as it broke the market top the next day, we've been selling since with no real counter trend moves yet. So how would we trade something like this? Well, you'd expect big counter trend moves like these, a lot like these and a lot like these. Here they are, big counter trend moves, and you would short at those levels around, let's see, the 70% level. So the 50-day moving average. So expect something like that. Short here, continue to ride it to the downside if that's what you want to do. Let's take a look at the summation index. NASDAQ summation index continues to point down. Uh, the oscillator very, very deep in the red. Again, usually when it gets this red, we get some relief moves, some quick bounces. Not always, but that's usually what happens. Okay, let's take a look at TLT, long-term treasuries up top. The S&P 500 is down here. What am I looking for on the TLT, the long-term treasuries? Well, I'm still looking for a double bottom. It hasn't formed yet. It will likely form in the next, let's say, 4 to 6 weeks. I'm actually looking for a lower low, something that looks more like this, right? A lower low with a higher low on the PPO that would establish a double bottom with a positive divergence. If we, let's see, drop a line from the levels from 2003 all the way to 2007 before the financial crisis, we get somewhere around the 88 to 80 range. 88 to 80 range. This is very long-term support, very long-term. We're talking about 20 years plus. So a multi-decade support level, a multi-decade bottom that is forming potentially, again, within the next 4 to 6 weeks. I will look for signs like hammer candles, things that look like this, a lot of rejections at the lows. We'll look for the PPO to begin to turning back up, and I'll look for the histogram to begin printing some green bars that will likely signal the turn in the TLT. And usually, guys, when the TLT bottoms and begins to rally, that's usually when the huge crashes begin in the market, okay? That's usually when the big crashes start. Let's take a look at the PC put to call ratio chart, still moving up. No signs of slowing down. Still moving to the upside. CPC still moving up. No signs of slowing down yet. Now, the PC and the CPC combined with the NASDAQ summation index and the New York Stock Exchange summation index, these are major trend setting indicators. They are slightly lagging, so usually the market would top ahead of these signals by a week or so, and it would bottom again ahead of these signals by a week or so. But when you get these signals, they're powerful signals because they set the trend for multiple weeks, sometimes multiple months. So far, the trend based on the NASDAQ summation index, the New York Stock Exchange summation index, and the PC and the CPC put to call ratios all still saying we're in a downtrend move, still in a downtrend. Let's talk about gold. Gold was forming this bull pennant. It broke. It is now below the 200-day moving average. Yields are exploding. Gold will likely bottom alongside the TLT. It needs yields to cool down. It absolutely needs yields to cool down. Yields will not cool down until the Fed announces the end of the rate hiking cycle. So we're looking at either September or October, potentially, with the final hike coming in September or in November. We still have some Fed meeting this year. We do have one in September. We also have another one in November. So if they don't hike rates in September, they'll do it in November. But either case, gold will not find a meaningful bottom until long-term treasuries bottom and until yields cool down. Okay, let's take a look at the fear and greed index. We printed the first neutral reading in a while, 52, down from extreme greed, 80, just a month ago. Look at this precipitous decline, the fear and greed. Greed is being rapidly replaced by fear as more and more selling comes in. Market momentum still showing greed down from extreme greed. Strength still showing greed down from extreme greed. Stock price breadth again, still at greed down from extreme greed. Put to call ratio is now showing fear. Volatility index, the VIX is showing extreme fear. Safe haven demand is showing fear. Junk bond demand, extreme greed because smart money is still buying high yield bonds. This is the HYG chart. They're still buying high yield bonds. High yield bonds have not broken down like the S&P 500 has. They're still holding up, and smart money is still buying. and that's why junk bond demand is still at extreme greed. Let's take a look at the economic events. Tomorrow we'll have the Philadelphia Fed Manufacturing Index and initial jobless claims before the market open. Friday, nothing much going on. Next week, not a lot going on until Thursday. We'll have the durable goods orders and not much else. So next week is going to be fairly uh, quiet in terms of economic events and in terms of earnings. Not a lot of earnings coming out next week. So if we continue to see selling this week, potentially next week will be the rebound. If we take a look at the weekly chart, we had 3 red weeks and we had a huge bearish engulfing candle a couple of weeks ago. We had a small fall through candle. This candle this week is much larger than the prior candle, which indicates that selling is accelerating. It's not slowing down, it is accelerating. If we take a look at the 20-week moving average, it actually coincides with the bottom of this cluster of trades and the top of this prior August high. So it does coincide with what we call, again, a pivot zone. We are already at the maximum pain level of 439 according to maximum pain theory. That's where the week should close at least 68% of the time. That's how the week closes, around the maximum pain reading. Let's take a quick look at seasonality. Again, a very, very negative beginning of August. Then we should start to see some rebound. We haven't seen any rebound yet. And in terms of the month of August, these are the trading days down here, not the date of the month, but the trading day. We're now at the 11th trading day, which should be an update. It is not. We're seeing more selling off of that FOMC minutes release. More seasonality here. Extremely choppy trading up and down for months, well into the end of November and early December. If we take a look at the Dow Jones Industrial Average, August and September tend to be okay months for the DIA, for the Dow Jones, because again, it's more value oriented, it's more defensive versus the NASDAQ, which usually sees very negative August, September, and October. That's all I have for today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.